Good evening, all. We'll wait for 2 minutes so others can join. Am I audible? Please confirm. Kunal, Tejaswini, Ankita, Vaishnavi, am I audible?
Yes, sir.
Yes, sir.
Okay, thank you. Are you guys able to see the PPT? Can anyone confirm? Are you guys able to see the PPT? Ankita, Kunal,
Yes, sir.
Vaishnavi.
Yes, sir. Yes.
Yes, sir.
So please answer. Don't wait for recall your names, guys. So in the last sessions, we understand what we are going to study in the subject that is international finance. Okay, so we will see little part in the last session. What is the international finance? Okay, what the scope of the international finance? We will understand the, we can say, the across the border trades, the we can say across the border monetary transactions. Okay, all the across the border economic activities happened between the two different nations. Okay, that all we includes in the subject that is international finance. We also understand why the international finance matters to us, as we all know that because of the technological advancement, the space in the development of the international finance is very fast, and due to this, we can say across the border trades, some of the, we can say, the international bodies like the World Trade Organizations, International Monetary Funds, you can say World Bank. So these are the regulatory body who liberalized the trade after the World War II, and due to this, we can say the frequency of the across border trades increases, and that's why the importance of the subject international finance, we can say, uh, increases over a period of time to the we can say the management students or for the business students. Uh, we finish up to that part. I think we finish the goals of the international finance. Now we in this session, so we understand the structure and the different participants of the global financial systems. Okay, how global financial systems works and what are the different participants uh, uh, in the we can say global financial systems. So there are some key financial institutions who plays, we can say, the key role in the international finance, and that is, we can say, the first one here given is the international monetary funds. So international monetary funds is basically is a, we can say, the international body. Okay, it is the global organizations who we can say they founded after the World War II. Okay, after the World War II, we know that the world economy is in a we can say in a very troubles. Okay, it is a very slowdown in the world economy because of the we can say the economically rich nations no, fight each other. The nations like the America, France, you can say Italy, Germany, Japan. J- so these are at that time these are the we can say the rich countries and they fight each other. So the world economy at a very we can say the slowdown. Only the American economy because of their huge geographical area and the natural resources they have, they develop at a very fast pace. Also the technological advancements we can say where happen very we can say fastly in the American economy. But what the world leaders at that time thinks that now after the World War II, they want to avoid the wars, and they want such a body at the international level that helps the other countries for their financial well-being for their economic development. Okay, so with that concept, the International Monetary Fund, founded in July 1994, we can say up to till date, we can say the near about 190 countries are the members of the that international we can say the financial institutions. And what is we can say what is the role of the international body that IMF plays in the well-being of their member countries. So first role they play is that is the promoting the economic stability. So what IMF do? They support the to formulate the different economic policies of the nations. Okay, they advise them and they maintain the financial stability of the country. Okay, so IMF thinks that we can say the financial stability of each and every nation is very important and crucial for the world economy. Okay, so that's why they overview the each and every member country's economic conditions and they ensure the financial stability. Uh, if the every country is financial stable, then they don't have the adverse effect on the other countries. As we know, whenever there is a recession came in the one country, the effect is automatically we will see on the other nations. As we all know that in 2008 there is we can say the recessions were in the America only because of the top of we can say the investment banks were bankrupt because of their we can say the heavy loan out without checking the proper documents and all these things. So because of the 2008 American recessions, the world economy faced the recession. So and because of that, the IMF ensures the financial stability of each member country. They also, we can say, helps. the global financial trades and growths. Okay, it works. The IMF works to expand the international trades and promote the sustainable economic growth. Okay, by we can say by conserving the environment, the IMF we can say helps for the economic development. Also, the IMF we can say give the monetary cooperations to their member countries. Whenever the any member countries don't have the enough dollars to pay their financial obligations, whenever any country import something from the other countries and they don't have the enough we can say foreign reserves to make their payments. Now, at that time, the IMF, we can say, helps that country for their balance of payments. Okay, we can say there are some natural calamities like the earthquakes, tsunamis. At that time, also the IMF, we can say, provide the funds to these countries. Okay, to ensure the financial ability in that country. So we can say the International Monetary Funds promotes the international monetary cooperations. Okay, they facilitate the trades and provide the temporary financial assistance to ensure the financial stability in the country. Okay, whenever any country is in the we can say the crisis of the balance of payments, they don't have the enough foreign reserve. We can say dollar. Okay, at that time, the IMF provides the funds for their payments. Okay, so next international body here given is the World Bank. Okay, so World Bank, we can say World Bank is we can say is the international organizations. Okay, is actually we can say helping the developing countries. Okay, to we can say for their development. Okay, whenever the any countries is lacking of the infrastructure, okay, lacking of the we can say the businesses. And at that time, the World Bank provide the loans and grants to the government of the low and middle income countries. For what to purpose of the pursuing the economic development. Okay, also the World Bank provides the funds. Okay, in we can say in some of the educational agricultures in the health to build the health infrastructures. We can say the irrigation facilities, the rural services. Okay, so the we can say the pollution reduction program, and for all these things, the World Bank provides the funds. Okay, so these are the two main bodies who work at the international level. Uh, we can say so, and these two bodies are we can say are the most important part of the international finance because they regulate the across the border trades and the we can say the balance of payment between the two different nations. Now next one is the central bank. As we are, you all are aware that the every country has a central bank. I also told you in the previous session that every country has the central bank to ensure the currency circulation in the country to print their currencies. As in India, we have the Reserve Bank of India. Same likewise, the different nations have their own central bank who controls the banking systems in that nations. As we all know that the Reserve Bank India is the bankers bank in the India. That means the every banks who work in the banking sector in India, they have their accounts with the RBI. Okay, so they keep their reserve in the RBI in the form of we can say the cash reserve ratio. Okay, so the CRR, SLR, that is the statutory liquidity ratio, repo rate, reserve repo rate. So all these repo rates, I thought that you all are aware. Okay, so all these ratios are we can say the RBI announces quarterly. Okay, to maintain the we can say the currency circulation in the economy. So same likewise, the every country has their central bank who controls the foreign payments. Same likewise, the RBI controls the foreign payments for India. Same likewise, the other nations like the United States have their Federal Reserve. Okay, so Japan have the Bank of Japan. China has the People's Bank of China. Okay, so the same likewise, the different countries have their own. We can say the central bank. Okay, so the we can say the national institutions that implement the monetary policy. So, as I told you that these different ratios are the part of the monetary policy. So by implementing this monetary policy, the RBI controls the currency circulation. They controls the inflation in the country. As we all know, the repo rate is the rate at which the other banks borrow the funds from the RBI. The rate at which the other banks, whenever they, we can say the lack of the funds, then the bank borrow the funds from the Reserve Bank of India. Okay, so the repo rate is linked with the, we can say the interest rate of the banks. So the repo rate is we can say is nearly, we find out that at the 5.6 or the 5.7%. So above that, the we can say the 7% the we can say the interest rates of the other banks. So this likewise, the central banks control the we can say the money circulation and inflation in the economy. Same likewise, the central bank assist the we can say the foreign payments. All the banks who has the permission or the approval, the some of the nationalized bank and the some of the private banks who has the permission to make the foreign payments. So these approvals and the permission is given by the Reserve Bank of India. Without the permission of the central bank, that is the Reserve Bank of India, none of the bank is able to make the foreign payments. What we call as the, we can say the we can say the financial transactions across the borders. Okay, now next one we can say the private financial sectors. That is, this is the some of the private banks, that is we can say the financial institutions, some of the investment banks. So these are the banks who we can say plays the major role on the international level. Okay, so the investment firms who made the investments across the border, what we call as the foreign direct investments. Okay, some of the multinational corporations who work on the international level, we can say they guided for the mergers and acquisitions. So all these things, so these are the key of institutionals who works on the international levels. Okay. Now next part is who are the, we can say the what the different participants who plays the major role on the international finance. Mm. As we know that each country is doing the trade with the other countries, so they have the permission of the we can say their government. So government is one of the major participants on the international level. Okay, so what role government plays in international level? They set the fiscal and the monetary policies. Okay, so fiscal policies is we can say fiscal policies part is we can say tax regulations and tax rate is a part of the fiscal policies. Also the government also we can say control the inflations and the money circulation in the economy. So they do with this fiscal policies. So fiscal policies nothing but we can say the control of the tax and tax rates. So government announced the we can say the tax policy in any nations. Okay, so whenever the any organizations come into the uh, uh, other countries, so they first analyze what is the tax policy of the government. If they found that the tax is benefited to their business, okay, so no businessman want to do a business in that country which is having a we can say the high tax regime. Okay, so every businessman wants the low tax and they wants the maximum profit. So as we all know that the business is doing their business for the two major we can say motive, that is the revenue and the profit. Okay, so no country wants we can say no country wants to pay the high taxes. Okay, they wants to pay the low taxes. Okay, now the monetary policies are we can say the announced by the RBI, that is the we can say the part of the government. So now next one is we can say the regulate the domestic financial markets. Okay, so the government have the we can say the whole control on the different financial markets in the country. As the government controls the different stock exchanges with the help of that is the SEBI, that is the Security Exchange Board of India. Okay, same likewise, they have the control on the insurance with the help of IRD. Okay, so these are the some of the regulatory body who work, we can say, on the with the permission of the government to control the different financial markets. Okay, also the government negotiate the international financial agreement. So as you now see the scenario that the Trump, we can say, put the tariff of 50% on India. Okay, so yesterday at 12 p.m. So the tariff of the 50% levied on India by the Donald Trump, that is the government of US. Now, what Indian government did? So, in Indian government, they started talk with the different allies, that is the Russia, China, Japan, different European countries, different African countries, and what we sells to the US. Now the same goods and services now we sells with these nations. Okay, we sells we can say major the pharma products to Russia, to China, to Japan. That means the government plays the very important role to negotiate the international financial agreements. Okay, that means the government to do that agreement, they thinks that we more benefited to their country. So we can say the role of the government is very important. If we can say now the central government is weak, what they do, they if they do not we can say make that alternate arrangement, they do not no, we can say talk with their different allies. So automatically the businessman in India, we can say hampered, we can say adversely, uh, they will have the losses in their business in a long run. So government is we can say is a very important entity who makes the arrangement, who makes the different financial agreements, who benefited the businessman in that country. So government is we can say the most crucial body. Now next one is the intervenes during the crisis to maintain the stability. So it is very important part, as we all know that the we can say we can say recently we all see the health crisis, that is the COVID-19. So in COVID-19 all the businesses are stuck. Okay, we can say all the markets are closed, there were no sales is going on, we can say there is a no exchange of goods and services in the economy. So how the businesses we can say survive in the economy? So at that point of time, what government can do? Governments can provide the subsidies to the businesses, to the small businesses, so they can survive the we can say the crisis period. uh, Same likewise on the international level, so government can we can say minimize the traffic tariff, they can minimize the tax. So the small businesses, or we can say the big businesses also, they can survive, and we can sustain the we can sustain the crisis, different crisis. It may be the natural calamities, it may be a health crisis, whatever it may be. So government is, we can say, a very we can say, important entity. So they can take the different these decisions to help it out to grow their businesses on the international level. Now, next part is the financial institutions. So we know that the some of the banks which are we can say a very rich, they have the very vast capital. Some of the banks from the we can say America. Okay, so some of the banks like the JP Morgan, Citibank, Bank of New York. Okay, these are the financial institutions who we can say made the international investments. What we call as the foreign direct investments. Okay, they automatically helps the poor and the developing countries because they provides the fund to grow the businesses. Same likewise, when they invest in the any country, they provide the technology also. Okay, so the financial institutions plays the major role because they made the we can say the across the border investment, that is the international we can say they provide the capital to the other countries. Next one is they provide the liquidity to the global market. Okay, whenever the big organizations having we can say uh, the cash requirements, they want the liquidity, they want the working capital, then what they do, they took the short-term loans from these financial institutions and fulfill their we can say the cash needs. Because as we all aware of, if the working capital is not enough with the any organizations, the organization is not capable of the we can say is in a running stage. Their production of the services and the goods may stuck. So at that point of time, the financial these international financial institutions, they provide the liquidity. That means they provide the cash in the global market. Next one is they facilitate the international trades. So these are the international entity, international banking. So they provide the banking services to the we can say the international companies, international corporations. Okay, when they do their businesses on the international levels, so they facilitate the international payments. And as we all know that when we import something, then we have rupees. Now we have to make the payments in the dollar. Okay, so it is not we can say these are the financial institutions who we can say they provide that facility of the international payment. Okay, they also they offer the different financial products. Okay, we can deposit the amount we have with this, they can we can say they provide the loans. Okay, so these are we can say some of the financial products the financial institutions provide. Now next one of the most important participants in the international finance is the investors. Okay, so investors is we can say it may be individual investor, or we can say the institutional investors. We can say who allocate the capital across the global opportunities. Okay? Whenever these we can say the individual investors like the Warren Buffett, or we can say the Mukesh Ambani, they are having the huge amount with them. They can invest in the other countries. So they invest. Okay, so they have the capital. They allocate their capital uh, across the global. Uh, and now next one is we can say the diversify portfolios internationally. Okay, so these are the we can say investors. They we made the portfolio internationally. They invest their huge amount with the different nations. Okay, finance the cross-border mergers and acquisitions. Okay, we all know that the across the border mergers and acquisitions where it happen. Like the Tata acquired the some of the companies in England. Okay, if you are know the Land Rover and all these, the some of the companies which are acquired by the data. So these are the investors who we can say take parts in the mergers and acquisitions across the border investments and all these things. Now we can say the regulatory bodies. Okay. So as we all see, that is the IMF and the World Bank, so and the central bank. So these are the regulatory bodies who make the rules and regulations for the international trades. Okay, who enforce, we can say, the transparency and they disclose or make the rules for the international trades. Now, next one is the coordinate the international regulatory standard. So the IMF, or we can say the World Trade Organizations, who make the rules for the across the border trades. World Trade Organization makes the rule for international trades. So they make the rules, and we can say we can say the overview. The rules is followed by the each and every member country or not. They monitor the systematic risk in the global market. Okay, if the anything happened, what are their consequences followed? Is, we can say, the analysis is made by the these regulatory bodies like the World Bank and the International Monetary Fund, because their main motive is to have the financial stability internationally. So they ensure the financial stability in each geographical area. Okay, so that's why they monitor the systematic risk. And now they implement the measures to prevent the financial crimes. Okay, as we all know that on international level also some of the financial crimes like the, we can say, the hawala, some of the crimes like the black money, uh, terrorist funding. So all these crimes, to overview that, and we can say to implement some of the measures to prevent. So all this part is looked by the different regulatory bodies. So we can say, so the all, we can say, the global world, we can say the all the world is the, we can say, the interconnected. As I studied told you that because of the technological advancement in the communication, because of the electronic devices like the laptops, like the smartphones, uh, computers. Okay, so all these things were present. Okay, we have the internet facility, so we can communicate very easily. Okay, we can make the payment very easily. So there is also the technological advancement in transport also. So the interconnect. So because of this, what happened? We can say we consider that the world is the one global village. Okay, we consider the world economy as the one economy, and by thinking this, we can say made the trade on the international levels. Now we understand how the global financial system work. We understand the functioning of the global financial systems. As we all now we just understand who are the different participants in the global financial systems. Okay, we understand what are the different financial institutions who regulates the global financial systems. Who are the, we can say, the participants in the global financial systems. Now we are going to understand the functioning of the global financial system, how global financial systems work, how the trade across the borders happen, how the, we can say, the payment on the international levels were done. That we are going to understand in this part, that is the global financial systems in the era of globalizations. Okay, so how the development in the international trades where happened, that we actually think that little part we see, that is the in the 19th century, what we did, whenever there is a import and export of the different goods and services across the border, they'll make the, they was make the payments in the gold. Okay, so this is the, we can say, the gold standard that were established internationally in late 19th century. Okay, but in when the, we can say, the currency printing, we can say, this starts in the each and every nation. Okay, the formation of the central bank in each and every nations. Okay, now the gold is not enough with the each and every nations to make the payments. Okay, because the gold is not with the each country, so they wants to make the payment in the other form, so they make the payments in the currencies. Now at that time the US is the one major developed countries, so the dollar is the dominant in the world economy. So the Bretton Woods systems created the fixed exchange rate That is, they we can say they put the fixed exchange rate of the dollar with the gold and with the other currencies, and accordingly that they make the payment on the international levels. But the America is not happy with that fixed exchange rates because they know the demand of their currency on the international level is very high. So they want the floating exchange rate. So the importance of their currency on the international market gets increased. So in 1980s, that is the we can say the we can say the floating exchange rates were there in the 1980s to now up to that. So in 1980s to 200, what happened? The liberalizations, uh, we can say, and LPG, if you guys see the liberalization, privatization, and the globalizations, were dominant in the market. Now, as we all know that the some of the socialist country like the China and the USSR, that is the today's Russia. So all these are the socialist countries. That means they are, we can say, they oppose the globalization, privatizations, and the liberalizations. But in up to the 1980s, the Russia and the China is lacking in the development as compared to US and the other European countries. Now they realize that the openness of the economy, that is the openness of the businesses, is very much important for the economic development. So they open their economy. India is also open. India's economy is in 1991. If you guys know the LPG, we can say we came with the policy LPG, that is the liberalization, privatization, and globalization in 1991. So near about in that area, all the economy opened the doors for the international trades. Okay, so in 1980s, the financial liberalizations and integration accelerated across the border. Okay, and so now we can say at the present time, the trillions in daily transactions across the super international financial networks. In today's area, there are, we can say, now the free trades were done between the different nations. So when there is a no free trades across the border, when the some of the political ideology, like the Trump thinks that the America first. What Trump thinks that the other nation take the advantage of the American economy. Okay, so okay, what he thinks that other countries earn the, we can say, the money by selling their goods and services into the American market. So that's why he puts the tariff on the different nations. Same likewise the some of the countries. Okay, so all the countries now take some, we can say, these safe policies. Okay, say they want, we can say, they come up with the policies of some trade barriers. Now, in, we can say, in recent times, we see such a scenario because of the US government. Okay, so uh, now next part is that how globalization shapes the financial stability and the policies today. How the globalization helps the different nations to grow financially, and we can say uh, to do the economic development. So as we all know that in 2008 we find the major recession on in the world economy because of the recession in the US. The major investment bank in the US were bankrupt. So the effect is largely on the America, and because of we can say America is the dominant economy in the world. So the other nations also face the recession. That means the recession means the slowdown in the economy. That is the, we can say, the, what is meant by the slowdown in the economy? We can say the customer don't have the enough cash to buy the goods and services. Okay, so the businesses is not able to sell what they are producing. If the businesses not able to sell what the goods and services they are producing, um, so they don't have the revenues, they don't have the profit, so they are not in a position to give the salaries to the employees. Okay, so they cut down the employees. Okay, as you guys heard that in the recession some of the individual lost their job. So this is the reason, that's why they lost their job, because of the companies don't have the revenues, because their customers don't have enough cash to buy the goods and services the companies are producing. So we can say in post 2000, after the recession period, the we can say the regulatory fragmentation, that is the geopolitical tensions and the strategic weaponization of the finance, that is the strengthens stimulus flow of the global capital and shake the confidence in the systems. Okay, some of the major steps were taken that to strengthen the global economy. Okay, now we can say the structural shift. Okay, that is the structural shift means that is the we can say uh, that is we can say the now because of the globalizations, mm, the America is the dominant economy in the world up to the we can say the up to the 2010. Okay, but now the some of the economies are like the China and India are emerging very fast. Okay, so now the we can say it's a challenge to the American dominance. So these are the structural shift we are found because of the globalization, and because of the globalization, the India and the China have the enough funds and the technology, and because of the found the we can say the structural shift. Okay, so we can say these are the things how the globalization shapes the financial stability. Okay. Uh, Now, next part is we can say the challenges in the globalized financial systems. So, what are the challenges there? We can say the global financial systems face. That is the we can say the volatility management. That is the we can say the risk management is one of the major challenge in the international finance because of we can say the here one of the example is given, that is the sudden capital flow reversal and exchange rate fluctuations can destabilize the economies. Okay, that means if the exchange rate fluctuate at very fast pace, okay, so that's adversely impact the different economies. Okay, as seen in 1977, that is the Asian financial crisis. If the exchange rate, as we know, as I told you yesterday, that is the exchange rate decides on which basis? On the basis of the demand and supply of the different currencies into the market. But if the fluctuations are very high in the exchange rates, that is the we can say risks are associated with that business. Okay, so it's a challenge on the international level to stay the exchange rate stable. Okay, so it is one of the major challenge. Now, next one is we can say the regulatory fragmentations. Okay, so as we all know that the different nations has the different regulatory body. They has the different regulatory rules framework. Okay, so the balancing the national regulatory framework with the needs of the international cooperation creates the governance gaps, because as we all know that the different nations have the different economical structure. That is the America has the open economical structure, India has having the mixed economical structure, China is having the closed economical structure, Russia is also having the closed economical structure. Okay, so because of this structure, that is the ideology of the different nation is also a different one. That is, we can say the America is we can say it is the open economy, that is the it is open for the businesses. Okay, so what is the things with Russia? Russia is, we can say, is the socialist country. That means all the businesses is of these government ownership. Okay, and India is having the mixed economy. That means some of the businesses is of the government's ownership and some of the businesses is the private's ownership. Okay, so because of these, we can see the ideological differences. The different nations have the different regulatory rules, regulatory framework. So when they do a business with each other, there is a, we can say, the governance gap, ideological gap. Okay, so and because of this, we can say the regulatory fragmentations, it is, we can say, it is a challenge in the business across the borders. So it is one of the most important challenge of, for the we can say, in the international trade, international finance. Now next one is, we can say, the sovereign risk exposure. Okay, so as we all know that the some of the nations are the politically unstable nations. Okay, the countries like Afghanistan, the countries like Ukraine, the countries like Iran. Okay, so all these countries are in a war situations, or we can say their regime or their government, we can say, change drastically. Okay, we have the neighbor, that is the Bangladesh. So these are the nations which have the political uncertainties. Okay, and the sovereign debt crisis, like the, we can say, okay, so these countries, we can say, we find it out the because of the political uncertainties. Okay, so the decisions of the government is not, we can say, that much precise. Okay, and because of that, okay, the risks is very high with this country if we are doing the trade. Okay. Now next one is, we can say, the sovereignty and the integrations. The nation struggle to maintain the economic sovereignty while benefiting from the global financial integrations. That means the every country wants the benefit from the international business. That is, they want the benefits from the globalization, liberalizations, and the privatization policy, but they want to save their economy from that factor also. So it is the, we can say, the major challenge. As we all know that the America is a developed and the richer country. Why it is so? Because they sell their weapons, they sell their technology. Okay, they sells we can say their major production in the other countries, and they gets richer. Now they thinks that they want to save their economy from the other countries. They do not want to give advantages to the other countries, and that's why the Donald Trump puts the tariff on the different nations, that is the 25% tariff, 50% tariffs. Okay, he came up daily with the different tariffs for the different nations. So the, we can say, the sovereignty versus integrations. Okay, so these two things, we can say, collidely collide with each other at the same time. It is very, we can say, the impossible thing. So it is also, we can say, it is a major challenge in the international trade. So these are the challenges. Now we are going to see the global risks. What are the, we can say, the risks? We can say we see that global risks and the global responses. Now we see the futures of the international trade. Now, what is the future of the international trade? And because of the international trade, as you are told you, that is the power shift to the emerging markets. And because of this policy of the globalization, liberalizations, and the privatization, that is the LPG policy, that is the most of the developing nations take the advantage. Now, as we all know that the China and India emerging at very fast pace. The countries like the America, the some of the European major countries like the France, Russia, we can say Germany, UK, Russia. So now they also, we can say, take these two nations, that is the China and India, very seriously. So and because of their, we can say, the economic development, the power shift towards the these nations. As we all know, the power is where when where there is a money. So we can say because of this, the reshaping of the global financial power dynamics. Okay. So the shifting of the powers to the emerging markets like the India and China. We can say, uh, and because of we can see the development at the international level. Okay, to we can say to have the revenues and the profit, the companies is not think of the we can say the environment. Okay, say it is a next point, that is the sustainable finance. That is some of the international bodies come up with the idea, that is the sustainable finance, that is we can say the green finance. The green finance tells us that the companies uh, can generate the revenues and the profit. The companies must, we can say, earn the revenues and the profit, but the companies must think of the environment. Okay, to conserve the environment. First, they think of this, and then they can generate the revenues and the profit. So here we think here the ESG, that is the environment, social, and the governance factors, who we can say uh, that is the indicator of the sustainable investment. So ESG investings and the climate finance becoming the mainstream in the international capital flow. Okay, so all the businesses are now think of the environmental conservations. Okay, so it is the very we can say the good part of the businesses that they think of the environment. Now next one is the enhance we can say the coordination. Okay, because of the we can say the globalizations or the international finance, we find it out the we can say a well coordination between the countries, because as we all know that some of the countries having some goods and services, some is having the different goods and services. Okay, so they we can say have the across the border trade. Okay, they fulfill their needs also, and they can we can say generate the income through these trades. Okay, so because of this, the coordination across the countries is also gets decreases, and one of the most important part, that is the digital transformations. Okay, that is as we know, that is because of the international trade, the some of the advanced we can say the blockchain, that is the cryptocurrencies, fintech innovations like the UPI, internet banking. Okay, so all these innovations were there because of the you can say the international trade. Okay, so all these things reshapes we can say the cross-border finance. So all these things, this is the future of the international finance, that is the power shift to the emerging market. Okay, in coming times, we do not see US is the dominance economy in the market. Now India is also is the same competitor to the US and the other developed nations, and China also, and some of the we can say emerging economics like Brazil, like South Africa. So these are also the some emerging economies in the world. Now onwards, the businesses think of the environment. So it is also the future of the international finance. Okay, the coordination will also increases, and the digital transformations. So it is all about we can say the today's sessions. If you have any questions, you can ask, or otherwise we sum up the sessions over here. Anyone have any questions? You can ask. No one have any question? We can stop here. Everyone understand? Ashwini Katkar, Payal Gidde, Ritesh Jadhav. Are you guys here in the session? Pranav Badgujar. Are you guys here in the session? Anyone have any question? Harshada Jagdale. Okay. Please confirm, guys. If you don't have any question, we will end the session. No one have any question?
No questions.
Okay. So if you don't have any question, you can leave the session now. Okay. We sum up the session. Okay. Thank you. You can now leave.